Silver doesn't usually move like a meme stock. It grinds, it chops, it fakes out both sides and punishes impatience. And then, in the span of roughly 30 hours, it did something that should make any serious market watcher sit up straight. 53, after trading near triple digits. Not months, not weeks, one session. Then, almost before the shock could settle, the market snapped back. 49, retracing a chunk of the crash with almost insulting speed. For a market that is supposed to be deep, globally traded, and efficient, that kind of whiplash is a stress test. It tells you something failed. People like to say metals are slow, that a market tied to factories, mines, and vaults can't behave like a speculative corner. They said this could never happen. And yet it just did, with price acting like it was being yanked by cables you can't see. That speed is the clue. The story is usually that someone was forced out. Forced selling doesn't care about the long-term story. It cares about today's collateral. And when forced selling hits, institutions already know the mechanics before the public even knows what question to ask. Retail sees a red candle and a green candle. Professionals see margin calls, liquidation ladders, dealer hedges, and the exact moment liquidity thinned out. What I'm about to lay out changes how this move looks, not because it predicts a price target, but because it explains why this bounce isn't normal. The market wasn't simply emotional, it was mechanical. And when markets go mechanical, they stop behaving the way textbooks promise. Welcome to Macro Mechanic, where we decode what matters. Before it becomes a headline, everybody pretends they saw coming. If you'd rather understand the plumbings and argue about the narrative, you're in the right place. Subscribe if you want more calm breakdowns like this, the way you'd keep listening to a wise elder who never shouts, but always brings structure. And drop a comment with where you're watching from, because this market is global, and the signals often appear in one region before the rest of the world notices. Now let's reconstruct what actually happened, step by step, with forensic detail. Start with the magnitude and timing. 53. That's the kind of move that compresses weeks of selling into hours. 49. A move that would normally be celebrated as momentum, except it came after a crash that big, that fast, the kind of crash that leaves fingerprints all over the clearing system. So what changed in roughly 30 hours? Not industrial demand, not jewelry demand, not mine supply, not the chemistry of silver. Those variables don't swing 31% overnight. What changed was positioning, financing, and the willingness of intermediaries to warehouse risk. When constraints tighten, price can drop like an elevator. And when the last forced seller clears, price can rebound like a spring that was compressed too far. At the same time, the public narrative was running hot. Social chatter around silver surged to roughly 20 times its 5-year average, and about $1 billion flowed into silver exchange-traded funds in January. That combination matters because it creates a crowded trade, and crowded trades are fragile. When too many participants share the same assumption, the market doesn't need a huge catalyst to break. It only needs a shift in the rules of leverage. Here's where it gets interesting. And while headlines were focused on mood, one institution-level clue was sitting in plain sight in the structure of positioning. A Chinese brokerage, Zhongkai Futures, built a large short position in silver on the Shanghai Futures Exchange, a position equivalent to around 484 tons of metal. 5 billion, 6 billion renminbi, roughly $519 million. That's not a casual bet. That's the kind of size that changes the landscape because it can influence hedging behavior, liquidity, and psychology across venues. Now add another structural layer. The US futures market's concentration metrics are public, but most people ignore them until stress makes them impossible to ignore. 9% of gross short positions. Concentration like that cuts both ways. It can fuel squeezes when longs press and shorts scramble. It can also fuel air pockets when overlevered longs are forced to sell into a thin book, because the market's balance depends on a small number of large players managing risk smoothly. 68 billion as of February 4th, 2026. That tells you scale. It tells you how much capital is using a vehicle that sits adjacent to futures. And it hints at the hedging chain behind the scenes, authorized participants, dealers, and market makers managing inventory and exposure in ways that don't show up in a simple up or down headline. So here's the central mystery. How do you get a historic crash and a sharp rebound while the public is still talking like demand is exploding? The answer lies in dislocations, the moments when two connected markets tell opposite stories. Silver is not just a commodity. It's a crossroad. It's an industrial input and a monetary metal. It trades on futures exchanges, in physical bars, in vault receipts, in ETFs, and in spreads against gold, the dollar, and interest rates. When the system is healthy, these pieces move together. When the system is stressed, they diverge. Divergence is the warning light, and in this episode, the warning light was blinking hard. To understand why this bounce isn't normal, you have to recognize the old playbook. We've seen versions of this before. In 1980, silver became the stage for an extreme collision between leverage, concentrated positioning, and collateral rules, all amplified by public enthusiasm. The outcome was violent, a rapid run-up, then a crash that taught an entire generation how fast a leveraged market can reverse when financing changes. In 2011, silver surged again, and then the market experienced abrupt, cascading declines that weren't explained by a sudden change in how useful silver was to industry. The declines were explained by the mechanics of futures risk management and liquidation pressure when volatility expanded and the market's financing became less forgiving. And now, in 2026, the pattern returned in modern form. The ingredients look familiar. A surge in social attention, heavy ETF inflows, concentrated, positioning on key venues, and cross-venue tension between East and West liquidity. The script is not identical, but the rhythm is fast run, crowded sentiment, high leverage, then an air pocket. Then a reflex bounce as forced selling exhausts itself, and liquidity providers step back in at wider spreads. Notice what this says and what it doesn't say. It doesn't require a conspiracy. It doesn't require a villain. It requires something far more common: incentives and constraints. Traders and institutions behave the way they behave because their financing, risk limits, and collateral requirements force them to. When those requirements tighten, selling becomes mechanical. And when selling becomes mechanical, price becomes erratic. That's the part most people miss. Let's talk about the players, because markets don't move by magic. They move because specific institutions pull specific levers at specific times. On one side, you have futures exchanges and clearinghouses. This is where contracts are margined daily. This is where volatility translates into collateral. On another side, you have brokers and prime services. They extend credit. They impose house margin. They decide when clients need to post more cash. Then you have dealers and market makers. They intermediate ETF creation and redemption. They hedge inventory. They manage exposure across futures and spot. And you have the reporting layer that publishes concentration and positioning data, which becomes crucial when the market is under pressure. In this event, the names that matter are the venues and the entities with size. COMEX is the primary U.S. silver futures venue, with standardized contracts, daily settlement, and a clearing structure designed to protect the system by forcing collateral adjustments. The Shanghai Futures Exchange is a major venue in China, with its own participant base and its own liquidity rhythm. When large positions build in either system, cross-market participants manage risk across both, and that is where timing matters. A shock in one place can force hedging in another place, and that hedging can move price faster than any fundamental story could. Shanghai Futures matters here not because it is good or bad, but because its reported position size is a fingerprint. A short equivalent to around 484 tons is not a casual view. It's an institutional stance. And it sits next to a world where social mentions are 20 times normal and about $1 billion poured into silver ETFs in January. That combination is a recipe for violent repricing because it creates a large pool of exposure that can become unstable if financing tightens. Now consider how ETF flows actually touch the market. When an ETF sees inflows, shares are created through authorized participants. Those participants can deliver metal or manage exposure through a mix of spot and futures. Dealers may hedge their risk with futures contracts as they facilitate the process. Well, this is why the same chart can look like a mystery to one group and like a mechanical outcome to another. Add to that the reality of concentration. 9% of gross shorts, the market's stability depends on how those traders manage exposure during volatility. If they are hedging, they may absorb moves until their risk limits force adjustment. If they are directional, they may reduce or add aggressively when liquidity is thin. Either way, their behavior can change the slope of the market's reaction. In concentrated markets, small changes in risk posture by a few players can look like a sudden regime change to everyone else. Now we arrive at the dislocation, the part that tells you this bounce isn't normal. The first dislocation is between narrative demand and mechanical selling pressure. These can happen together because one is about desire and the other is about constraint. A leveraged participant can believe deeply in silver and still be forced to liquidate because they ran out of collateral. A fund can receive inflows and still reduce exposure because its volatility target was breached and its risk model demanded a cut. In that moment, the market is not a democracy of opinions. It is a hierarchy of constraints. The second dislocation is between price action and the pace of real-world adjustment. Industrial buyers don't cancel orders overnight. Mines don't double output overnight. Yet price fell 31% in one day. That tells you the marginal trade setting price was not an end user buying metal for production. It was a leveraged participant or an intermediary reducing exposure under duress. When that is the marginal trade, the market behaves like a credit instrument, not like a slow-moving commodity. Price becomes a function of collateral, not a function of supply and demand in the everyday sense. The third dislocation is structural and geographic. East and West do not always share the same dominant participants, and they do not always share the same financing environment. A large position on SHFB may be influenced by different funding constraints than a large position on COMEX. When participants hedge across venues, stress in one can trigger mechanical actions in the other. That's how localized positioning can produce global price shocks, even when the physical metal in warehouses did not move an inch at that exact moment. Now let's lock in the evidence, because numbers turn suspicion into structure. 53 on January 30th, 2026, 49 by February 3rd. 6 billion renminbi, roughly 519 million since Friday morning. The sentiment and flow included social mentions at about 20 times the 5-year average and roughly $1 billion flowing into silver ETFs in January. 9% of gross shorts, 68 billion as of February 4. You see a market that became crowded, leveraged, and structurally fragile. Now, when fragility meets a trigger, the break is fast. So what was the trigger? Often it isn't a headline, it's a threshold. In leveraged futures markets, the trigger is the moment volatility spikes enough that risk managers tighten conditions. Clearinghouses and brokers set the rules for collateral. When daily ranges expand, required margin can rise. House margins can rise even more, and financing can dry up. A trader who was comfortably margined in a quiet market can become under-margined in a volatile market without changing their view at all. That trader then has to post cash or reduce exposure. If many traders face the same constraint at the same time, selling becomes synchronized, and synchronized selling creates the very volatility that justifies tighter collateral. It's circular. This is the mechanism. It's a chain reaction. First, price drops enough to increase volatility. Second, volatility increases collateral demands. Third, collateral demands force liquidation. Fourth, liquidation pushes price further, increasing volatility again. Fifth, liquidity providers widen spreads or step back because the risk of catching a falling knife is too high. That makes the book thinner. A thinner book makes every sell order move the price more, and the loop accelerates. Here's a simple analogy. Imagine a crowded theater where everyone is holding a balloon. In a calm room, balloons are harmless, but if one balloon pops, people jump, balloons collide, more pop, and suddenly the room feels like it's exploding even though nothing new happened. Now, leverage is the balloon, margin is the jump, liquidity is the space between people. When the room is too crowded, a small shock becomes a chain reaction. That's why this bounce isn't normal. A normal bounce is gradual, driven by fundamental buyers stepping in after value appears and staying in. This bounce has the fingerprint of a liquidation event, a sharp drop that exhausts sellers followed by a reflex rally as forced selling ends and liquidity providers re-enter, often after widening spreads and resetting risk. It can happen even if the broader trend remains unresolved because it's not about conviction. It's about clearing. But the data shows something else entirely, and it's the part that separates a relief rally from a resolution. After liquidation, the system needs to reprice risk. If the underlying dislocation remains, the market often enters a phase where it swings harder than normal, testing participants, shaking out weak financing, and probing for where real liquidity sits. The bounce can be the beginning of the next chapter, not the end of the story. Now, forward analysis, not prediction. Pattern. Historically, when a market experiences a leverage-driven break and then a rapid reversal, volatility tends to cluster. The system doesn't snap back to normal overnight. It searches for equilibrium. It tests levels. It reprices risk. And it forces participants to reveal whether they are still overexposed. There are a few scenarios that show up repeatedly. A conservative scenario is stabilization. Price churns in a wide band as open interest falls, leverage players reduce exposure and spot, and futures relationships normalize. In this case, the key is whether the market's internal stress indicators cool off. Watch whether open interest declines in a controlled way, whether daily ranges compress, and whether violent intraday spikes begin to fade. A moderate scenario is a second wave. After the initial rebound, price revisits the lows or breaks them as delayed margin effects and risk reductions continue. This happens when the first drop was only the first layer of liquidation, and more selling arrives as funds rebalance, brokers tighten conditions, or volatility targets remain breached. In this scenario, the rebound becomes a trap, not because buyers were foolish, but because the system had not finished deleveraging. An aggressive scenario is squeeze and snap. Concentrated shorts, cross-venue constraints, and renewed inflows can create sharp upside moves when liquidity is thin and shorts reduce exposure. This can happen if the fragile piece is on the short side, and forced buying becomes self-reinforcing. In this scenario, the key is not hype. The key is structure, unusually tight liquidity, sudden spread behavior, and positioning shifts that suggest forced buying rather than fresh conviction. None of these require certainty. They require observation. The market will show which scenario is being selected through its internal metrics, not through anyone's confidence. And this is where the divide appears. Some people will look at the 30-hour reversal and call it a miracle. Others will look at it and see a machine that briefly jammed. The difference is not intelligence. It's attention. It's knowing which data matters when the chart stops making sense. The information gap becomes a wealth gap because institutions move on mechanics, while the public moves on stories. Institutions track positioning, collateral, and flow. They watch concentration, not commentary. They recognize that when social mentions spike 20 times normal and about $1 billion pours into ETFs, the market becomes fragile to the smallest trigger. 9% of gross shorts, the market is a pressure vessel. When pressure rises, the release is rarely gentle. It is abrupt, loud, and confusing if you only watch the last traded price. This is the part no one is discussing. The bounce itself can be a symptom of stress, not a sign that everything is fine. When forced selling ends, price can rebound sharply even if the underlying dislocation remains. That rebound is where complacency sneaks in because it feels like relief. But relief rallies are not resolution. They are the market catching its breath. There are also a few concrete signals that tend to reveal whether a reversal is healthy or purely mechanical. One is open interest. When price rebounds while open interest falls, that often suggests positions are being reduced and the market is cleaning itself out. When price rebounds while open interest rises sharply, that can suggest fresh leverage is piling back in, which historically increases the chance of another sharp swing. Another signal is the behavior of the major ETF vehicle relative to futures. If holdings keep rising but futures volatility stays elevated, it can mean the hedging chain is still strained. If holdings stabilize and futures ranges compress, it can mean intermediaries have regained the ability to warehouse risk without widening spreads. A third signal is cross-venue positioning. If large positions on one exchange remain heavily skewed while another venue is attempting to normalize, the tension can persist, and persistent tension is where sudden moves are born. And finally, watch how silver behaves relative to the broader macro backdrop. Silver is sensitive to the dollar, to real rates, and to risk appetite. But in episodes like this, correlation can break. When correlation breaks, it's often because plumbing is dominating fundamentals. That doesn't last forever, but it can last long enough to surprise anyone who assumes yesterday's relationships will hold tomorrow. 49. In a matter of days, treat it like a message, not a conclusion. It's the market telling you that positioning and financing were stretched, and that the unwind is powerful enough to override common sense in the short run. And that message is louder than any headline today. Macro mechanic is where we decode what matters before it becomes tomorrow's recycled talking points. If this connected dots you hadn't lined up before, you know what to do. Because the question isn't whether silver can move violently again. The data has already answered that. The question is whether the next move will look normal to the crowd while the mechanism is doing something else entirely.